Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds to reach financial independence as quickly as possible. So in today's video, we will review the top 10 investing lessons that I've personally learned in 2022 as a long-term income-oriented or income-focused investor. So I did a similar video for the 2020 lessons learned, which was a pretty crazy year. I didn't do one for 2021 because it was a pretty bull year. It was a good year for everybody, mostly 2021. And to be honest with you, it's really only during the bad times or the bear markets or when there's a lot of volatility and uncertainty where you really learn some lessons the hard way or the easy way. So 2022 was pretty crazy. So I figured it would be a good video to do, a good complement to the recent video I did where I go over my personal 2022 performance review or portfolio performance review, which was really, really well. I beat all records. It's been my best year yet. But 2022 was a pretty crazy year. So let's go over the lessons learned that I've learned as an income-oriented investor in 2022. Let's get started. All right, so lesson number one, and this is more of a reminder, is that owning single stocks or single companies is completely unnecessary. All right, so it doesn't matter if you're an income investor like myself, if you're a dividend focused investor, which only focuses on dividend stocks, or if you're a growth investor who either picks and chooses individual stocks or goes into the passive index ETF. My point here is that whatever your style is, you don't have to stock pick. You could get ETFs now for pretty much any style of investing. So why am I saying this? Well, because if you buy a single stocks or the individual company, no matter how amazing the company is, you have a single point of failure, right? So your fate is really tied to that company. So whether you're an income investor, dividend investor, or growth investor, you're much better off, in my opinion, of course, getting an ETF which either has a bunch of dividend stocks, which either has follows an index like the S&P 500 or a Canadian version of that, like the TSX 60 or the TSX Composite, et cetera, et cetera. You're lowering your risk tremendously. It could save you a lot of heartache down the road. So that would be lesson number one. Lesson number two is that fixed income or bonds is also completely unnecessary now. So a lot of you might disagree with me, and that's completely fine. So fixed income traditionally is more of a conservative investment, right? Government bonds, corporate bonds are a little bit more, definitely are a lot more stable. But now with all the great options you have on both the Canadian and US market, my opinion, fixed income, investing in bonds or bond ETFs to bring stability or defense to your portfolio like a 60-40, completely unnecessary. You have so many great options on the Canadian market. You have the preferred shares of a split fund, for example. You have very conservative covered call or options ETFs like a ZPay from BMO, or Purpose has PYF or PayF. So there's a lot of options where you could still get that 5%, which is typically what bonds will give you, but with much more tax efficient income. So for example, the preferred shares of any split fund like a DFN or an FTN or a bank, et cetera, or even the Brompton ones, the income is pretty much going to be eligible dividends, right? So it's much more better taxed in a cash account than bonds, which is taxed as income. Regular income rather. On the US side as well, now instead of getting bonds, you could get a covered call ETF, which actually has the bonds, where you could get a lot higher yield. So I'm talking about those three new BlackRock iShares, where they have the 20-year government bond, they have investment grade bonds, and regular junk bonds or high yield corporate bonds with covered calls. So you could get high income with even lower risk, thanks to those covered calls, a much higher yield than just owning the fixed income. So there's a lot of options out there, guys. In my opinion, fixed income is completely unnecessary nowadays. Lesson number three, and I hate saying this one, but I have to admit it, split share funds or split corporation can also be unnecessary now. So this is because of the new all-in-ones that have come out. So you have BMAX from Brompton, HDIV, HYLD from Hamilton, and HDIV from harvest, and hopefully there's more that come out. So these covered call all-in-one solutions have the best of what the split funds have: a little leverage and covered calls without the complications of the closed-end fund structure that split share funds have. So split share funds are closed-end funds, don't forget that. So they typically have higher fees, they have termination dates, you got to think of overnight offerings, and there's a lot more moving parts, a little bit more complicated with the structure. But now these all-in-ones have pretty much the best of both worlds. They have the best of the ETF world and the same characteristics that we love from the split share funds. Now, am I saying that they're obsolete? No, they could still be a part of your portfolio, a secondary part of your portfolio. But I'm just saying that now with all the great options, and there's even the Harvest enhanced ETFs as well, right? They came out with 25% leverage versions of their 5 of their very popular covered call ETFs. So you have a lot more options now to get what the split funds give you, that high yield, because of leverage and covered calls. You can get it in an ETF form. So that's number 3. Lesson number 4, investing in niche assets adds risk and can also be unnecessary. So what do I mean by niche assets? Well, when you invest in something that's very sector specific, that covers only one sector or only one region, like, you know, an ETF that only has energy stocks, or an ETF that only has technology stocks, or even things like investing in that the Bitcoin and Ether yield ETFs from Purpose. Although they have the covered calls and they're designed to give you monthly income, they're still very niche assets. It's not diversified. So investing in any niche asset, everyone, simply adds risk. Because your faith is more tied to that sector or that asset compared to, you know, getting something that's diversified, which has everything. And what I've learned is that, you know, you don't have to invest in those niche assets anymore. I'm not saying it's wrong to do so, but I would, you know, consider not making those the priority or the primary part of your portfolio. The primary part of your portfolio should always be diversified funds. That's again why I love those all-in-ones, because you have those. You got that diversification. Lesson number 5 is that leverage is king. So I absolutely love leverage. I hate taking it on myself, or I would never borrow money myself to invest. I think that's risky. But now with all these fund managers that are offering these modestly leveraged products, 25% leverage, 33% leverage, that's BMAX. If you're a long-term investor, so like the title says, guys, don't forget, I'm talking about lessons as a long-term investor. This is very important. If you're long-term, you're planning on buying and holding for 10, 20 years, you might as well have a little bit of leverage on it, as long as it's quality assets. So because it just increases your returns and it increases your yield as well. So the numbers don't lie, guys. The funds or the covered call ETFs, funds that have leverage, are outperforming the ones that do not, that have the same thing that do not, right? So it's only normal if you have two things, an index or something with quality, and one has 25% leverage, the other one doesn't. After 10 years, the one with the leverage will of course outperform. So yes, it could add some short-term volatility with the stock price, but because I'm a long-term investor, I don't really care about that. So leverage is definitely king if you're a long-term income-oriented investor. Next lesson I learned is that volatility, fear in the market crashes, price declines, is actually cause for celebration if you're a buy and hold income investor who keeps buying regularly. So there's been a lot of fear and volatility and headlines and crazy stuff in 2022. That's cause for celebration for someone like me or someone who invests like myself, because I'm really buying and holding and just investing regularly over time. So when things go down, you have the opportunity to dollar cost average, to buy them cheaper, which increases your yield and just helps you long term, right? Because the market goes up more than it goes down. So it's a really important privilege, or a really underrated privilege, as a long-term buy and hold investor. So whether you're even a growth investor or income investor, dividend investor, you shouldn't be afraid. It should be a cause of celebration when there's volatility, because no matter what, you could buy cheaper units. Next lesson. Not caring about stock prices really is a huge privilege. So this is a privilege specifically for a buy and hold long-term income investors. So there's a lot of fear in the market, and if you have single stocks, or if you have those growth index ETFs, your fate is pretty much tied to stock prices, right? You got to buy low to sell high. But as an income investor, I make my money with a consistent passive income. So I'm not really worried about stock prices, and especially when they go crazy like in 2022. So it's a huge advantage psychologically. It'll keep you calm and peaceful, and that's extremely underrated. Next lesson, covered call ETFs are doing their job, they do their job, and they outperform during bad market times, side markets and down markets. So 2022 proves it, right? If you look at any, for example, index-based covered call ETF like QYLD, even though it's gone down, it's still doing better than QQQ. That's where that income comes in to really prop up that total return to help you outperform the index or the corresponding asset without the covered calls. So covered calls, obviously this is a no-brainer, right? It's kind of more of a reminder. Their job is to outperform during the bad times, and they've been doing that in 2022, no doubt. So it's a very defensive type of product, a defensive strategy. Next lesson that I learned is that it's getting much easier to be an income investor. We are absolutely spoiled for choice now. So 2022 was a blockbuster year when it came to new products, new covered call products. And stay tuned, I actually have a video that will cover all the new products quickly in 2022. But it's getting so easy to be an income investor right now. So 2 years ago when I first started, just to give you an example or to try to give you a landscape of the market, the income market or covered call ETFs, if you're newer to this style of investing, there was no all-in-ones, right? HDIV, HYLD, HDIV, BMAX, these are all newer products. So back in the day or 2 years ago, you basically had to pick and choose individual covered call ETFs to have that diversification. For example, you have to have HHL for healthcare, you have to have a technology one, an energy one, financials one, and what do I choose, the covered call ETF or the split fund? There wasn't many diversified income-oriented vehicles back in the day. Now it's getting much easier. We have a lot of choices, right? There's the all-in-ones, the split funds are still there. There's regular vanilla covered call ETFs, which many of them have come out. Now there's leveraged covered call ETFs, right? Harvest came out with 5 of them. You have things like Bank from Evolve. You just got a bunch of new, Horizons refreshed their covered call lineup. You have QQCC, which is kind of like the equivalent to QYLD. Evolve actually has 2 new products in the works, covered calls on S&P 500, which is kind of like XYLD and JEPI, and covered calls on the TSX 60. So there's a lot of new products which are index-based or diversified. So it's much easier now to be an income investor, which is a fantastic thing. And lastly, but not least, the biggest lesson that I learned, and this is more of a reminder in case you're newer to this style of investing, is that this style of investing is all about the income, right? Is a huge safety net. That's your defense during the bad times, right? You're not dependent on stock prices. You're not buying low to sell high. So if the market's doing really bad and you're just buying and holding, and even though your portfolio value is going down, you're still getting that realized profit, that realized income every single month, which puts your minds at ease and provides you that safety net. So consistent passive income is always a good safety net in case of whatever emergency, you lose your job, you always have that consistent passive income. Of course, there's exceptions like the split funds where they might not pay out, but that's just within their structure. And like I said in my third point, split funds are kind of unnecessary right now, so you don't even have to deal with missing dividends anymore. So the income strategy is really a defensive strategy, and the consistent passive income does provide a good level of peace of mind and give you that safety net in case the markets go nuts. So those are the lessons that I learned in 2022. I know a lot of them I repeat all the time on my channel, but I figure I do this video to really go over them. Have I missed any? Let me know in the comment section below. Don't be shy. So yeah, there it is. Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I'm not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors, so make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website, and don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.